Alpha activism, the new voice of stewardship, why engagement should not be limited to ESG strategies. The idea, of course, is that investors who are not following an ESG strategy could cut risk, perhaps even boost long-term returns if they work with management to improve their operating practices. And here are our panel. Thank you for joining us in today's webinar. I'm Mark Dunn, editor of Portfolio Institutional, and this panel discussion, of course, about alpha activism. We've just talked a little bit about engagement, so we'll continue that theme here. Could we just start by introducing ourselves? Jennifer, could we start with you?
Hi, good afternoon, Mark. Good afternoon, everyone. My name is Jennifer O'Neill. I'm an associate partner at Aon, and in my role within the responsible investment team, I work with institutional investors of all sizes to help them determine their approach to responsible investment, a core part of which is stewardship and engagement activity. Look forward to today's discussion.
Thank you. Good to have you on board, Jennifer. Matthias.
Hi there, good to be here. I'm Matthias Lomas. I work at Guy's and St Thomas's Foundation. We're a healthcare foundation.
Thank you, Matthias. Michael.
Yes. Hello, everyone. I'm Michael Herskovich. I'm the global head of stewardship within BNP Paribas Asset Management. So representing a global asset manager, investor, and really in charge of the effort towards engagement and voting for the firm.
And finally, Peter.
Hi, I'm Peter Mennie. I'm global head of ESG integration and research at Manulife Investment Management, and very pleased to be here too.
Good to have you with us. Thank you, Peter. Can we kick off this particular session with you, Matthias? Can you just explain what difference engagement has made to the portfolios at St Guy's and Thomas Foundations?
Yeah, sure. So good question. Although we're relatively new to engagement at the foundation, we are already starting to see an impact on our portfolio. So we have dual objectives. Firstly, to have financial returns, but then to have health impact, given we're a health foundation focused on tackling health inequalities. A particular area of focus for us recently has been nutrition and engaging with supermarkets, which ties strongly to one of our key charitable programs. Obesity is a really big issue, and we've seen that with COVID. It's a key symptom of health inequality, and high rates of obesity are linked to low incomes. But we also, in the endowment at the foundation, strongly believe that investors should be concerned about it for economic reasons. It costs the NHS billions, I think 6 billion every year, the economy over 50 billion every year in lost productivity. And the majority of money is spent in supermarkets, that is spent on food in the UK and around the world. We've recently had success in engaging Tesco as part of a collaborative engagement programme. So we filed a resolution back in February, and we're very pleased that Tesco have now announced really ambitious targets to increase their sales of healthy foods. So we're really happy about that. It's such a big deal, given £1 in every £5 is spent on food. On food in the UK is spent in Tesco. So we're already starting to see impact today, and we're going to be expanding our engagement programme, really focusing on collaborative engagement, deepening our work with our partner Share Action that we filed the resolution with Tesco with. And also we recently joined the Access to Nutrition initiative, which is a great source of common data on the healthiness of food, which is so important in engaging on the obesity crisis. And we'll also be engaging more with food manufacturers and focusing on environmental health linked to climate change as well as employee health.
So from your point of view, engagement does actually work. Jennifer, bringing you in now, is engagement just for investors who adopt ESG strategies in terms of what we've just heard there from Matthias in terms of trying to fight things like obesity?
Thank you, Mark. I think I'm going to give you quite a direct answer to this question, and then I'll explain my answer. But my answer is no. It's not just limited to investors that have a particular ESG focus. So let me just expand on that. I think engagement is applicable to passively managed strategies, it's applicable to actively managed strategies, it's applicable across asset class. So thinking about the pension scheme context, for instance, and then we'll reflect on other institutional investors. Reflecting on that engagement activity is now an annual requirement, that they must produce a public document that sets out what engagement activity has been undertaken over the course of the year? What does that look like? What are the outcomes of it? So that sort of regulatory context and backdrop, I think, really sets the tone. And combined with the expansion of the UK Stewardship Code, the 2020 revisions to that, which really broaden the remit of the code and really make it very clear that engagement and asset stewardship is relevant across the asset class spectrum, moving away from what was previously a relative focus on listed assets, I think is another underscore that engagement activity is really applicable across the spectrum. So different investors will, of course, have different priorities, and I think the outline there from Matthias is really a very helpful indication of what that can look like. So the priorities of the foundation are going to look different versus some of the investors that I work with that are, for example, focused on climate risk as a long-term systematic risk, and will therefore focus their engagement activity on addressing those risks, protecting the downside and looking to enhance the upside. So that means that it will look different across investor types. It's not necessarily just focused on investors that have a particular desire from an E, an S or a G point of view. But what's really crucial is that investors are aware and engaged with that activity, and that they're able to articulate how that's approached and how that's reviewed.
Thank you, Jennifer. Michael, I saw you nodding along there. So is engagement just for strategies labelled ESG?
No. So I was just validating what Jennifer was saying. I'm totally agreeing with the approach and what was said. I think that, engagement should be for everyone. Of course, you need to be adapting depending on each investor, each engagement strategy characteristic of the investor. And to complete to Jennifer's point and to explain, to give a concrete example for us, we're a global asset manager. We have some specific ESG strategy. We have both active and passive investment. So we have different type of strategy, and nevertheless, we have engagement even for strategies that are not, I would say, labeled as ESG. To give you a concrete example, and it's going to echo the first panel before us on exclusion on ETF. We have exclusion policy. We have excluded and decided to sell some stocks on some specific sectors, some specific activities, such as the coal industry or tobacco. Nevertheless, we might be for some ETF passive position still be a small investor on those companies. And in that case, we are going to engage with those companies, and we are going to try to change their approach, change their strategy. Nevertheless, so it's going to be on small position on ETF, while it's still going to be an engagement that is done. So I think that, and to complete Jennifer's point, I think that's clearly a topic for every investor, and depending on its characteristics, of course, the engagement will be adapted.
Thank you very much, Michael. Peter, just bringing you in now. You've got larger investors, such as maybe like hedge funds or large individual pension funds, insurers. What sort of things should they be asking? What should they be discussing with a corporate if they want to improve its profile and ultimately improve long-term profitability?
Yeah, so I completely agree with what Jennifer and Michael just said, in that engagement is clearly a critical part of any good investment management program. You've got to you invest in a company, and then you engage with the company in order to improve that company, and that has rewards both in a sustainable sense in giving us a sort of better outcome for the world, as well as in a financial sense in giving us better financial outcomes. And I think probably the agenda on sustainability has really changed now in a fundamental way over the last 2 or 3 years, because so many governments have been accepting net zero targets, have been setting very clear targets. We can see the agenda in terms of how regulation is changing. And so this kind of dichotomy between financial outcomes and sustainability outcomes is sort of starting to disappear, because if a company isn't considering sustainability and they're not thinking about what they need to do, they're really missing an opportunity. So it's almost, it really is, I think, incumbent on nearly all companies now to be thinking very clearly about sustainability, because it will affect the financial outcome they can deliver to their investors. So when I think about engaging with a company on the sustainability issue, I think one way into that discussion and one way to persuade the companies to be more open, more acknowledging of that, is just to point out how all-embracing sustainability is now. If you think about where the investment opportunities are going to be over the next 20 years or so, there's going to be massive upgrades, for example, to electricity grids in order to service electric cars and so on. And that's going to be a huge opportunity. It's going to need funding, but it's going to be a huge opportunity for companies to deliver on. And you can kind of walk through nearly every sector and you can see that. The IEA published a major report a few days ago, which I thought was really good as well, looking at the demand for materials and how that's going to be influenced by, for example, the development of EVs. Typically, an EV has, I think, 6 times the mineral usage of a conventional car. So it's changing the investment landscape and it's changing the financial landscape. So for me, that's the key way you engage with the company. You kind of highlight to them how this is just crucial for you financially as well as for the planet.
Thank you, Peter. Jennifer, it's all very good what we've heard so far, but what's needed to encourage a wider range of investors, not just pension schemes, to make their portfolios more sustainable?
I think this is a really interesting question, Mark. I work with not just pension funds, but institutional investors of various different types. One of the common characteristics of those investors that I work with tends to be a relatively long time horizon. And I think we can apply this in a couple of different contexts, including to individuals. So perhaps we'll come back to what this means for individual investors as well, in the context of, for example, defined contribution pension funds and having really flexibility to select their own mandates. But just coming back to the time horizon point, first of all, I think what really unifies the desire of those investor groups is a need to ensure that returns are generated over the long term. And that desire for long-term sustainable return generation is really what is fueling the recognition and the adoption of greater awareness and focus on encouraging sustainable business practices, trying to avoid that focus on very short-term corporate outcomes and focusing on how that connects to the longer-term context. So I think there are 2 things there. One is around how those practices come together over a multi-period time horizon. And secondly, what is the transparency regime around that? So, for example, a lot of the shareholder resolutions that we've seen being talked about recently connect to greater disclosure at company level of how the company is considering issues like climate risk in its systematic business planning and oversight and management. So those transparency initiatives and desire for disclosure help those institutional investors to understand how sustainable that company is, and therefore, does it have a part in my portfolio? So when it comes to the asset manager context, managers that have a very comprehensive, thorough and detailed framework for addressing those issues at company level are going to be coming to the fore relative to those that perhaps aren't quite so advanced in that space. So succinctly, time horizon and transparency.
Thank you, Jennifer. And Michael, when you meet an institutional investor, an asset owner, a new client, and you're trying to persuade them to take maybe a more sustainable strategy, I mean, how does that conversation go? What is it you say?
Well, first of all, I mean, quite often clients goes to us because they see us as a sustainable investor. So I think that the position of the company has always been to position ourselves as sustainable and to position ourselves as sustainable not only for the benefit for the planet, for the externalities that we will create it, but really believing that being sustainable will be positive for our clients, for performance-driven consideration. I think it probably sharing all this belief, I hope so, but really believe that the financial interest of our clients, we're asset manager, we're managing money for our clients and the interest, and the economy at large will be beneficial if we are incorporate responsibility issues. So that's our speech, that's our belief. That's not just a marketing purpose. That's really our strong belief that we should do both, and we should manage money to generate return. And by doing so, we need to incorporate a sustainability factor into investment decision and stewardship. So what has been, I think, great is we've seen clearly more interest from clients on that ground, to RFPs, through demands, to look more carefully of this approach and having more conviction, I think, for more and more clients that that sustainability is important, not only for the externality, as I say, but for financial returns. And of course, I mean, Jennifer has mentioned it, there is an important regulatory push. NGO and other stakeholders such as NGO are playing a huge role towards pushing the industry to being more sustainable. And I think that everything is going on the right path for that purpose.
Thank you very much, Michael. Thank you. Matthias, if we turn to you, you started by telling us about some of your successes in your engagement strategies. It's interesting what we've heard here about returns and things. I mean, have you seen through your experience that there was the potential to drive higher returns from a good engagement strategy?
Yeah, I think, again, picking up on some of the themes here that we've been discussing and what Jennifer said about the long term, I think with health, we really do see that in the long term, it totally makes sense from a financial perspective that there will be an impact on returns. So we think that, I mentioned we have these dual objectives of financial impact and health impact. We think there will be crossover there. Health is a really huge systemic issue. It's arguably the biggest issue behind climate change. It's not considered a key factor by ESG investors. But if you look, for example, at Tesco, we think in the long term, their returns are more protected now because they're moving ahead of significant headwinds. And it's analogous to climate change, again, because there's increasing regulation. In fact, in the last 6 years, there's been more sugar taxes than carbon taxes exist in the world. So regulation is a big headwind. Consumer change, consumers are demanding more healthy food, and they're only going to increase that demand because of the huge effect of the pandemic and the link between obesity and dying from COVID. So definitely, I think in the long term, it's too early for us to say now because we're fairly early on this journey, but we do expect an impact on returns. And also, if you look at traditional methods, of competitive analysis like Porter's 5 forces, threat of new entrants, a threat of substitution, these sort of things are heavily affected if you don't move ahead of the curve in an area like sugar taxes. So it just logically, it seems very linked with returns. But I think get back to us in 5 years or so, and we'll have a much stronger evidence base to really say.
Thank you very much, Matthias. Jennifer, with the work you're doing, are you seeing much evidence of it actually not just cutting risk, which was the old sort of argument for adopting them, but can actually boost returns long term?
That's certainly our expectation, that an appropriate engagement framework and an appropriate asset stewardship framework really does incentivize not just corporates, but also other investors to focus on the issues pertinent to those businesses. And by doing that, it's certainly our expectation that is conducive to a better forward-looking environment than one would experience otherwise. So it's very, very difficult to separate return and risk. And we should always be mindful of the other when we're talking about one, but that downside risk mitigation is a critical factor for the investors that I work with, alongside safeguarding the generation of returns on a forward-looking basis. So that's certainly our expectation, that by having an appropriate stewardship and engagement framework, that is conducive towards building those two things.
Thank you very much, Jennifer. Peter, would you like to come in and add anything to what we've just heard?
Yeah, I mean, I completely agree with both of those comments. Very good observations. And I think we've spent quite a bit of time year on year, people sort of asking, are ESG funds outperforming some other fund in this particular short-term time horizon? And for me, I think the key issue is that companies that are considering sustainability issues, they're considering how they're governed, they're considering what the world will look like in 2030, 2040, 2050, and so on. They're more forward-looking companies. They're companies that are more likely to take the steps now to address the challenges their businesses may well face in the future. And so they should be the companies that can offer you both better risk profiles and better reward profiles. Because fundamentally, if you wait till the problem is upon you, you're likely to have to, it'll likely cost you a lot more to achieve that, and you'll probably have lost a lot of market share while you do it. So for me, what Jennifer and Matthias just said is really true. You need a strong engagement program, and you need to encourage the companies to be considering sustainability issues, because ultimately that should help them, and it should help the risk reward profile of the people that are investing in those companies.
Bearing in mind what we've just said and what we've been hearing, is this sort of engagement strategy, is this only for a long-term mandate? What about if you've got a short term? Is it just doesn't matter?
Well, from my perspective, I'll comment quickly and let others comment. I think it doesn't matter how long you're holding an investment for. I think you should be considering sustainability factors obviously before you make any investment, and then once you've made the investment, to my mind, it's your duty to then be engaging with the company, to encouraging them to report and disclose better to you, and to make changes. I think that's just fundamentally part of being an investor. Once you've invested, you don't sort of walk away and wait and see what the return is. You engage, and I wouldn't care if it was a week investment or 10-year investment. I think whilst you own that investment, you definitely should be engaging with the company and seeking to improve outcomes.
Thank you very much for that, Peter. Michael, same question to you. Engagement is only about generating returns in the long term. What about short-term mandate?
Sure. So I don't think it's necessary to be long term. Of course, it's going to be helpful. Why? Because if you consider engagement, quite often you need time to have success. You need to build relationship. You need to build trust with company, and sometimes you can get results after months or years of engagement. So being long-term investor be helpful in that task. But nevertheless, we had some examples of, I would say, short-term engagement where huge impact has been done on really a short-term horizon. And I'm going to give one concrete example that happened last year regarding Unibail-Rodamco, which is a real estate company, blue chip company in Europe. Their price was trading around 33 euro before their general meeting. They were proposing a capital increase, highly dilutive, and we with others had an important engagement campaign with the company. There was even activist shareholders, external candidates to the board, and to reject the capital increase. At the AGM, the capital increase was rejected. Three board proposals were approved. The management was changed. All of that happened, if you look at the stock price, in 10 days. So before the AGM, it was at 33 euro. 10 days after the AGM, in a 10 days period, the price stocks was around 60 euro. So almost doubling the price in a 10 days limit due to engagement and voting activity. So you clearly can. So it's an extreme example, but it can give a concrete example of how engagement and voting can really shape and have an important impact, even to a short-term horizon.
Michael, thank you very much there. That's a good point to end on. Quite a fascinating discussion. I think that we were sort of on the side of this is not just for strategies labelled ESG, sustainable, responsible investment. This can be something adopted by everybody. There's something in there for everyone. And of course, the benefit of this could be a sort of greener, cleaner world, or stronger communities and better governed, better led companies. So guys, thank you very much for that. You made some very good points. Fascinating discussion. And of course, I hope to catch up with you all again soon. Thank you, Michael, Peter, Jennifer, and Matthias. Thank you.
Thank you.
Thank you.